Hello, students, and welcome to lecture number 5, where we're going to talk about your marketing plan and going into another country. Let's do a little share. Let's start out talking about laws, regulations that might impact your marketing plan and public and private marketing resources. First type of issue we need to decide if we're going into another country is the type of company or type of entity. Let me give you some examples. In the US, there are generally four types of organizations that you'll think about. The first is what's known as a sole proprietorship. You open a company, you don't make anything formal. It's just known as, Joe person's company. Nothing special. That's known as a sole proprietorship. If you get sued, for example, they sue you directly. Now, let's jump over to the right to S Corp and C Corp. Now, a C Corp is just a general corporation, and you've probably all heard of a corporation. And basically, a corporation is a legal entity that the state recognizes. You file in the state, and they say, okay, you are such and such corporation, whatever name you come up with. And then to make money for investment, people buy shares of your corporation. You'll also have you'll have shareholders, you'll have a board of directors, which will have to meet regularly. The board of directors will hire your president, vice president, secretary, etc., and they'll name them every year in an annual meeting, etc. The beauty of a C corp is that if the corporation gets sued, then you, the owner, shareholder, are not personally liable. So if I buy a uh, iPhone, or if I get a Microsoft product, if there's a problem, it blows up or something, and I sue Microsoft, I don't get to Bill Gates's money. I can only go after Microsoft. So it's a good way to protect assets, and the investors, shareholders in this instance, don't have to worry about it. I'm going to ignore S Corp for right now, but there's many lawmakers, maybe 30 years or so ago, said, the C Corp is a great idea for getting new investments and protecting our investments, etc. But they said, what about, but we have to have the shareholder meetings, we have the director meetings, we have to file this and this and this. What if there's something between a sole proprietorship or a partnership, which should be on here but is not? And a partnership is basically just two people. So it's not a sole proprietorship, but two people. What if something like a partnership and a C Corp, something in between, and they form the limited liability company? Same thing, your assets are protected if you get sued, but you don't have to file all the C Corp uh, things, regularities. Now, non-US examples, there are things, let me just give you an example of a couple of countries. UK, they have what's known as a public limited company, and that's where shares are offered to the public. For example, you've heard of the New York Stock Exchange. Those are publicly traded companies, the shares are. But in the UK, if it ends with Ltd, it means it's privately owned. The shares are not offered. Malaysia is similar, kind of a hybrid between the US and the UK. They have sole proprietorship, which you now know. They have a partnership, which they also have in the US. Limited liability partnership, private limited company, et cetera, et cetera. So, depending on where you set up business in another country, first determine what type of business you should set up for tax reasons and et cetera. Often your accounting firm is very helpful with that. Once you do promotions in a certain country, there may be legal restrictions against certain type of advertising. For example, outside the US, pharmaceutical sales are often not permitted to be advertised. For many years, Germany had a ban on comparative advertising. Pepsi couldn't say Coke, Coke couldn't say Pepsi. That's changed. And in many countries, advertisements aimed at children may be unlawful. Unlike the US, where you have these cereals every Saturday morning or whenever the cartoons are that. Um, as far as international trade laws, export, you just refer back to lecture two. We did a lot of looking at the laws of what you have to do for trade laws. For distributors or representatives or agents, let's say you get an independent agent in that country, you decide not to set up there, but you're going to have an agent or a distributor or sales representative there. Well, various countries have laws protecting those types of sales representatives. Um, you have to worry about non-compete or antitrust, exclusivity, and damages if you terminate a sales agent. In other words, in many countries in the EU, for example, if I terminate a agent, I may owe them money even if they were not really selling or doing a good job. Point here is also become familiar with the local laws in a country having to do with your distribution network, retail, sales agent, etc. We already talked about the Foreign Corrupt Practices Act. And keep in mind, it just means do not be involved in bribery. In other words, giving a gift to anyone that is government or quasi-government to obtain or to retain business. That can be a felony. All right, public and private marketing. Now, there is so much data out there now available to where we can look into trade statistics. So, as you'll see on key concept here, trade statistics can tell you which countries are growing, can tell you the economic demographics. It can tell you so many things that help us decide, our product is suited for that country. And these sites on the bottom can actually help you generate a table, helping you understand if your product might be well received by demographic or income, etc. Here's another thing, another various things to look at. Obviously, economic, demographic. If you are in cosmetics, for example, demographics is going to be very important. Not only everything from ethnicity to income. Well, do I sell the high-end cosmetics? Where do they sell them in this country? Is this country poor enough that we're going to just have to not sell our high price line there, et cetera, et cetera? There's a lot of considerations. Sectoral, and that's whenever you see sector, it just means they're dividing up the market basically based on industry. So when you do research and so you're doing your Google search or Chat GBT, if you do sectoral, it'll help you look up the type of industry you're in, manufacturing, power, medical, whatever it happens to be. So that's a helpful search key. Um, Here's an interesting concept, comparative market receptivity indicators. And so actually, certain market reports help you research whether the local consumers would be receptive to your type of product. Very helpful research if you have the money to pay for that kind of research. Next. After you've looked at the market, keep in mind we were just looking at the country or region, then we come back to the products. You've all studied in undergrad the four P's of promotion, product, price, place, and promotion, or four P's of marketing, I beg your pardon. So, market segmentation, keep that in mind. Considering the marketing mix, let's just jump in. This is an overview. Let's go next. So, export marketing plan. It helps you address basically it's a business plan for exporting. So you're going to go to the CEO, the VP of sales, or whatever, and you're going to have a proposed as middle management, you're going to propose which product at what price. Keep in mind, I might be able to sell things into Switzerland for a lot of money. I'm probably not going to be able to sell it into some other countries at that price. Location, where it's going to be made and where we're going to sell it, and then promotion, How are you going to sell it? Great little video on the four P's. I'd ask you to go ahead and pause and go ahead and watch this. All right, welcome back. Um, Product again. This is hopefully this is redundant that you guys remember this from marketing, but basically the product. But in international commerce, we have to decide: can I export as is? Do I have to change? I mean, if I'm selling electronic products and I'm selling them into the UK, I'm gonna have to change the current. I'm gonna have to change the plug. There's a bunch of things I will have to change. So the first question is that you're gonna have to go back to engineering. Can it be exported as is, or does it have to be modified? Okay. All right, let's see. Jumping on pricing, you're before you even go in, you should have a lot of data that's going to tell you at what price. Now, here's a key concept that is very important to tell the CEO and especially the CFO when you're talking about going into a new country. You may have to say, look, now I don't know if there's a test question on this, but this is an important thing to understand. If you think about from taking an order to manufacturing to selling to after sale service, this distribution chain, if you will, the more things you offload, more tasks in that chain, the lower price or margin you're going to get on your product. What do I mean? Well, here's a good example. So let's say I'm just the manufacturer. I go ahead and export. Well, my freight forwarder of my total 100% price or margin, however you want to call it, my freight forwarder is going to take 2%. My customs broker on the other end, my shipping is going to cost 10%. My broker, custom import broker on the other end is going to take 1%. My distributor, if I'm using a distributor on the other end, is going to take 15. And if I'm selling retail, like in stores, if you will, in the foreign country, they're going to take 46%. So what do I mean by that? If you were involved in every one of these steps, like you set up a store in that country, you're getting 100% of the margins. But every time you take a step back to the left, other people are going to take more margins and you're going to get less and less for your product. So that's a very real consideration for you in distributing internationally. Some companies will say, well, we sell it our product for $100 here. So we just need to add export. And export's going to cost another 50%. So we're going to sell it for 150. Well, everybody can get on the internet and see that you sell it for 100 in the US and try to order it directly or order it from your competitor who's selling it at 100. So a very realistic alternative to that is that you actually look at the customer and decide what they can pay based on where they are and then work backwards from there. Is that fair to be able to do that? Well, promotion. So let's get back into promotion. Your media, are you going to use media, word of mouth, et cetera, et cetera? A lot of going into a new country, a lot of manufacturers might start low unless you're like Sony or some really big company that can just saturate the market. Most start slow and don't spend much on advertising in a little area, see how it does. And if it does well, then increase advertising, marketing, etc. throughout that country. Part two, again, you need to adapt to local cultures and norms. I'm not going to beat that concept to death. Now, market segmentation and demand analysis. Whenever you're going in to sell, yes, there's a market there, but you have to segment or divide your market into segments to decide what are my customer groups, maybe by age, gender, occupation, where they are, behavioral usage, income, etc. And you have to identify the segment that best fits your product and advertise or market to that segment. If I'm selling farming tools, I'm probably not going to advertise on the Housewives of Beverly Hills. I'm probably going to advertise at agricultural stores or agriculture magazines or etc. It's the key is you need to find your segment and then target them. Something that to me is very important is demand analysis. Don't just go to your CEO and say, hey, there are potentially $10 billion of sales in that country. It's better to come from the back end, right? We see how big the market is, but we only have three salespeople in that market. They can contact 20 customers a day. We think they can close on two. That is a realistic view of your potential sales that first year in that market. Not it's a $20 billion market, but I've got three guys working. Okay. The next is, and by guys, I don't mean gender specific. So it's also good to go and find out what your what your competitors are doing in that market. Good idea. All right. In fact, I don't know if you ever noticed, but there's a thing called the Burger King model where McDonald's does research, research, research. And then in a lot of cities, McDonald's or Burger King will just see where McDonald's is set up and then within a mile set their store up. And it's some call it the Burger King model, but if let's say you're number five in an industry, you might see where the lead industry leader is going. Oh, they went into Brazil. I'm going into Brazil. They might spend $1 million doing research that you don't have to do. You might tag along. Okay. And that talks about looking at your competitors and their market share in the market. Now, how do we go into the market once we decide where we're going? Well, we can sell directly. You could sell from the US by web-based sales, which is misspelled there. There we go. Retail sales. In other words, we could go into stores. We could do agencies or distributors. We could do licensing. And I'm going to explain all that as we go forward. Target market, again, we'll jump right to here. Here's some concepts. Indirect exporting just means either there's an export management company already in the I'm using the US as an example in the US, and you piggyback. You just say, hey, they're already selling into Japan. Let's sell our products into Japan through them. They've already got advertising, they have distributors, they have etc. Really low effort way to get into Japan, but keep in mind you're not going to make as much money for your product as because the export management company is making the money. Piggyback exporting, export trading, same thing. We might do direct sales and either have employees in Japan or we might have employees here, servicing from here. But I mean, time zone differences, linguistic differences, after sale service next to impossible. That's difficult to do. So many countries will actually get in-country distributors, agents, or sales representatives. It's such a good model for like business to business sales, not retail generally, but business to business, because I just get a distributor in Japan who's Japanese. He goes to the customers. He's there for after sales service, et cetera, et cetera. So and he's not my employee. He's employed by his own distributor company in Japan. Again, I don't make so much money, but I make sales there. What are some of the other methods of going in? Having a local presence. We might decide to set up a representative office, our own manufacturing. We might have a joint venture with a Japanese company. There's an existing Japanese company. I have something they don't. We'll just have a joint venture. In other words, we go into business together with them and share the profits. I think you're all familiar with licensing and franchising. McDonald's doesn't own all the locations, but it does franchise. You can use the McDonald's name. You can, you know, this is our way of doing business, etc. And then you pay me a franchise fee, but you're a local person that owns the McDonald's of Tokyo. We already talked about indirect marketing, piggyback marketing, etc. I'll get rid of that one. Um, Next is that explains a little bit more export management company, piggyback exporting, which I'll let you read over, and indirect export companies. What are some of the advantages of indirect exporting? Well, again, you don't have to have any international experience. You don't need more managers or salespersons or anybody to serve this. You're selling to a domestic or US company, and they're doing all the risk, or that they're doing all the work to sell into Japan. Conversely, we get a lower margin. If they're doing 70% of the distribution chain, we're probably only get paid 30% on the product. Also, we don't know, we're not getting customer feedback. We don't have direct contacts with the customers, et cetera, et cetera. So it's difficult to control that. Again, here's the same chart. The further you go to the right, the more margin you make. The further you go to the left, the less margin you make. Direct exporting, direct sales. Again, I'm going right into the country. I'm selling direct. I've got employees selling in Japan. Again, a sales agent or rep, they're not hired by us, but I hire them. You don't have to worry about linguistic problems. They should be familiar with the local customs, the local business practices, the import, et cetera, et cetera. Now, one important distinction here. A sales agent or sales representative are basically the same thing, but I want to differentiate them from a distributor. Agents and representatives are selling for you. When they get a purchase order from a customer, they just send it back to you. So the agent representative is not buying from you, they're selling for you. Conversely, a distributor takes title, they own it. They buy the product and resell it. And that's the way they make money is by buying it and reselling it. So the first guys, agents and sales reps, they make a sale for you and then you give them a commission, maybe 20%. The distributor sells and they might mark it up 20%, and that's how they make their money. Now, back on agents and representatives, it's good because you know who the customer is. You could provide service after the fact. If you lose that agent, you still have your customer list. Conversely, with a distributor, you don't know all that information. They are they have the customer list, so it's kind of hard if they're not working out. It's kind of hard to go to a new distributor. Here's a little video for you to watch on common exporting methods. We talked about licensing, franchising is similar, but basically, let's talk about licensing. When uh, let's say Apple doesn't want to start a plant in China, they might actually give a local Chinese company the plans, the designs, the manufacturing know-how to make and sell the iPhone, and then they would get a license fee, maybe 30%, and the Chinese company has all the costs and makes it in China. So they get their 30%, and the Chinese company gets whatever their margin is, their profit. So that's known as licensing. I own intellectual property, patents, trademarks, etc., manufacturing know-how, and we have an agreement where I grant you the right and I disclose a bunch of secret information or protected information, and then you have the right to use it, but you have to pay me. That is a license. When you get new software on your computer, you don't buy the software, you're just buying a license to use it. So that's a good analogy. Franchising, you all know about franchising, McDonald's model. Let's skip that. A representative office is kind of a cool thing, and we're going to get into some more topics, but there's a new, not new, but let's say that your CEO doesn't want to spend all the money to go set up a plant overseas, or have a huge sales staff or whatever, doesn't want to invest millions in a new country. There's a thing called a representative office that you can just send a salesperson or multiple salesperson to rent an office in another country. Let's use Singapore as an example. And for usually it's 5 years, depending on the country, but you're not taxed in Singapore on your income. You're just, it's sort of a way for you to establish a presence, find out if you want to be in that area, that country or region permanently. And then if you do, you transition from a representative office over to a regular company in that country. Why would Singapore, for example, do that? They want to get as many businesses as possible into Singapore so their taxes go up and up and up. So representative office is a cool thing for starting, and you look like a genius explaining that to your CEO. All right. Overseas manufacturing, we talked about that. If you literally want to set up a plant, I don't think this is tested, but a couple of good concepts to know are greenfield and brownfield. Greenfield means I go over to a new country and I just buy a plot of land. It's a green field is the way to remember it. And then I build my plant. Brownfield is there's already plant there and you just go buy it. So those are a couple of concepts to remember. Again, I'm trying to make you look good to the CEO, so you're paid well and they know how valuable you are in your job. Joint ventures, we talked about this. It's a handshake. I'm going to work with you. We'll have a strategic alliance or joint venture agreement, and two companies are going to come together, kind of like a marriage, but for business purposes. Like our partner might have all the sales and distribution, and we might have manufacturing. We would joint venture together. Some countries require the local or to us foreign country joint venture partner to own 51% or a majority of that company. All right. We already talked about direct exporting. When they say subsidiaries, that just means that your company or your parent company will form a company they own and put it over there. There's a lot of tax reasons and et cetera, which I won't get into. What are the advantages of direct exporting? Well, obviously, you have greater control. You have direct involvement with the customers, with the market. You know what's going on. You're getting market feedback. Do I need to change my product? Um, some of the disadvantages, it usually costs more and you're getting less money. Um, you don't have direct access with the customers, et cetera, et cetera. All right, that was pretty quick, but that indeed is lecture 5, and we'll see you for lecture 6.